Hello, good afternoon. Welcome to today's webinar. Very good afternoon to everyone, and good morning and good evening to those who are joining us from other time zones. My name is Rohit Ambas. I am a lawyer with the corporate and M&A team at Kazan. I'll be your host for today's session. Our topic today is warranty and indemnity insurance. As an insurance product and a risk management tool, it's still growing in the Indian market. And so our endeavor today would be to provide an overview of some of the big picture concepts in W&I insurance, such as why do you need W&I insurance? What are the key commercial concepts in a W&I insurance policy? And at what stage of an M&A transaction should you obtain W&I insurance? So to talk us through these steps and these concepts, we are extremely glad to have with us today Mandira Gupta. Mandira is Senior Vice President at Marsh India and also the practice leader of their private equity and mergers and acquisitions group. And our second panelist today is Bharat Anand. Bharat is a senior partner in the corporate and M&A practice here at Kazan. So we have divided today's webinar into two parts. In the first 30 or 35 minutes, we will have the panel discussion on the topic with Mandira and Bharat. And in the final 30 or 25 minutes, we would be really happy to address some questions from the audience and the participants today. So please do send us your questions live. You don't have to wait till the end of the webinar to send us your questions. You can send them using the questions box on your webinar portal. In case we are unable to answer all the questions in the webinar today, we will certainly get back to you with our responses over email after the webinar. Also, after the webinar, we will get back to you with a recording of the webinar and the slides. Before we start, just one final word on technical issues. Most of us are working from home these days, and we hope that we can bring you the best possible experience without any interruptions. In case any of our panelists drop out due to a technical issue, we would aim to keep the discussion going, and we'll try and get the panelists back on as soon as possible. With that, Tejas, can we please move to slide 1? Thank you. Now, we have 4 segments in today's webinar. In the first segment, we'll be looking at why do we need W&I insurance? What's the advantages that it provides? In the second segment, we'll be looking at some of the key levers or the key commercial concepts in a W&I policy. We have a couple of case studies after that, which we will go through. And finally, we'll take a very high-level look at the overall W&I process and the timelines. Tejas, can we please move to slide 3? Thank you. So my first question here is for Bharat. And Bharat, as we know, W&I insurance serves as a risk mitigation tool, as an insurance policy in an M&A transaction. It acts as a risk mitigation tool. Do you think that this is an objective that's particularly relevant in today's times?
Yeah, thanks, Rohit. So, before you start examining the relevance of the tool as such, one has to look at the broader context of what is happening in the M&A market. And the M&A market clearly has gone through crazy disruption on account of COVID. Essentially, how do you price an asset? Are you getting the best price today because values have been impacted and the price will go upwards later? Or are you overpaying today because of the necessary interlinkages of markets and companies? The price is actually going to stabilize much later and you're catching a falling knife. So in that context, you have to evaluate the players. Right? So who are the players in the M&A market today? You have distressed sellers. They create a credit risk for any buyer. You have leveraged sellers who may not be distressed, but very often the money that you're paying them will end up with the banks. So they may give you an indirect credit risk. You may be looking at a COVID round. There are many COVID rounds happening in the market on venture capital backed companies. But really, how effective is it to go after management and founders? So that's a challenge. And then, you have a situation. In fact, I was involved in one of these a few years ago where the lead seller had 20% and the rest of the capital was held by multiple sellers, IT-backed company, based in Bangalore. But while the buyer was willing to accept a 20% liability cap on the aggregate value, for the major seller who held 20%, it was 100% of the value that he was getting. So in a case where you have multiple sellers as well, who's going to actually bear and backstop the liability, because the multiple sellers were all individuals and the buyer did not want to go after all of these individuals. So there are many, many instances, particularly in these times where there is a gap and someone has to come in and really bridge that gap. So I think W&I's relevance is, exists in normal times. I would say certainly sharper in these times. And I'll maybe just take another minute. One product, and we were chatting with Mandira before this webinar about its availability. Maybe it will come in the near future, is the ability to buy assets from a distressed seller where there is a probability that the seller may go into insolvency in say a year's time or 2 years' time. And really the concern for the buyer is that, look, if although IBC has now abated, and so that risk is more of a theoretical risk, but the concern still exists that, look, what happens if tomorrow the transaction is challenged as an undervalued transaction under the Insolvency and Bankruptcy Code and reversed. So in a situation like that, can I go ahead and get insurance to insure myself against this risk? And as Mandira will tell you later, perhaps the Indian market has not matured and reached that level, but Western markets have. So, and I can tell you, talking to the promoter community in India, there are so many pre-IBC transactions which are ready to take place right now, so long as we can legislate for the undervalued transaction risk. But today we can't legislate for it, that risk can't be priced in. But again, as and when our regime matures and changes, W&I would provide an alternative, in this scenario. So I'd say holistically speaking, looking at the market, certainly it's a very relevant tool. Thanks.
Thank you, Bharat. Mandira, now to you. It would be great if you could add to what Bharat mentioned about the relevance of the product in this market. And also, I think it will be helpful, just at a very high level, if you could outline what a W&I insurance policy is, specifically what is the kind of risk that it is insuring, who is the policy holder, how is it different from a traditional insurance product?
Sure, thanks Rohit, thanks Bharat, and firstly thank you for having me over for this webinar. I'd like to I echo what Bharat said. The relevance, the fact is that the number of policies that we placed are increasing. We used to place far and few policies about 5 years back. We do a significant market share now when it comes to W&I policy, which just shows the relevance of the product has significantly gone up. Before we get into specifics, I think just to introduce what the concept is, what W&I is. W&I policy, as the name suggests, is an M&A specific insurance. It's an insurance which is taken on a transaction, and therefore it is a non-recurring policy, right? Unlike your typical forms of insurances that you take, you would take a policy today and then keep renewing it every year to make sure it is in effect. A W&I policy, because it's an M&A specific policy, you actually pay a one-time premium to start the policy, and it is there for the life of whatever SPA periods that you have agreed. Now, what does it cover? See, traditionally, your seller indemnity is what this policy covers, right? What you would have in an SPA is a seller providing reps and standing behind with indemnity. This is exactly what this policy is replacing. The policy is now being replaced by an insurance where the insurance company stands behind tomorrow if there is a loss because of breach of rep. The policy covers only unknown. I think that's one thing we should just put it up there. Anything which is not known is what the policy picks up, and any breach of rep is what the policy will pay. Because it's an M&A specific insurance, it's a bespoke policy. What that means is you negotiate the policy to the T. I know Bharat and Rohit have done it in the past on their transactions. It's not a policy that you will take off the shelf, right? The way you'll take a motor policy, whatever the insurers give, you have to take that. No, this is negotiated. It's a backward looking policy, so which means that an event has already happened, the loss has already happened. It's just the discovery of the loss hasn't happened, which is a key difference from other traditional insurances. The other insurances, say a motor policy, you take it today that in case you get into an accident, it pays up. No, this is the situation where the loss has already happened. It's just that you don't know about the loss. The diligence didn't throw it up, or the seller didn't disclose it, seller didn't know about it, and that's what this picks up, right? And like I said, it's a one-time premium. So basically what you're trying to do here is find a clean, neat solution to replace your traditional indemnity with an insurance policy backed by an S&P AA plus rated company.
Right. And the entity that's underwriting the risk here is a regulated entity. It's a solvent entity. I think that definitely provides a lot of comfort to the policyholder. And I think that factor also then ties into some of the advantages or, the strategic uses of the policy. Some of these now we have set out here. I hope the audience can see this. We have set out 5 key strategic considerations as to why W&I insurance might be advantageous for your deal. So this is both Bharat and Mandira. Could you take us through some of the strategic considerations and talk about the advantages of W&I?
Sure. Should I go first, Bharat?
Yes, please.
Sure. So, because like we said, what is the reason for having a W&I policy? It is to get the transaction done. It's a deal enabler in my mind. The idea for this insurance is that there are a lot of strategic reasons because of which a transaction sometimes gets stalled, stuck, and doesn't progress. One simple example is mismatch in expectation between the seller and buyer from an indemnity perspective, right? Seller is giving an X amount of indemnity, say 5 or 10% of the deal value versus the buyer asking 20-30%, right? Now that's one situation, a practical situation where I'm sure a lot of people on this webinar would have faced, and that's what this policy helps you. It bridges the gap between the expectation that the buyer and the seller have. It could be a situation where you're in an auction process. You want to differentiate your bid versus the other guy who's participating in that process. One way of doing it is to let the sellers know that, hey, Mr. Seller, my bid is X, but it also comes with a W&I policy such that I'm not going to ask you for any indemnity in the SPA. So my offer sort of becomes superior to somebody else's who might be asking for escrow, holdbacks, indemnities in the SPA. It could be situations where a private equity seller is selling their asset, right? And as we all know, they all have a fund life challenge, right? By the time they make an exit, they might not have the luxury to provide 7 years of, say, tax warranties that law requires typically on an M&A transaction. Or even financial sponsors, they're not the guys running the show, so they can't put their hand on heart and be absolutely sure on what is happening with the asset. So these are some of the reasons why we've seen, W&I policy being picked up. And Bharat, we were discussing fraud is obviously one big area of coverage, which makes this product quite, interesting for clients, is that the policy actually pays up in case there is seller fraud, which means if the seller has withheld material information, seller has willfully misrepresented something in the SPA, the policy actually pays up if the insured is a buyer in the policy.
Yeah, no, I think that's a big point, Mandira, because very often people who have not looked at the terms of these policies, particularly when buyers are getting these policies, overlook that that fraud can be covered, and it becomes a big point, particularly in domestic transactions, or where there are domestic buyers really of the policy. So I think I'm glad that you got that clarification out of the way. For me, the strategic use is really, I put it under, give you 2 reasons. One is eliminating uncertainty, and the second is, use your entire M&A toolkit. So let me explain both to you. When I talk about eliminating uncertainty, imagine if you were you're buying an asset from someone who holds the asset through Mauritius, and you entered into your SPA in Jan of February of 2020, just pre-COVID. And recently we've had the ruling by the AAR in the Tiger Global Flipkart Singapore matter. Now, had you closed that transaction merely on the basis of a legal opinion and the fact that the TRC existed, relying on the fact that, look, pre this ruling, the policy was clear, right? The government, through the various case law and the circulars, made the policy clear. Then they said, yes, we're going to renegotiate the treaty. And so they had a transition period. And now the policy is clear that there is no benefit if you're coming in today of the tax treaty. But, the AAR ruling throws all of that clarity into doubt. It creates that uncertainty. Now, if you were a buyer of shares held by a Mauritian entity, simply relying, on the diligence and on, say, a legal opinion, there would be huge uncertainty associated with your transaction today, and possibly you would be looking at ways out. Whereas if you had the benefit of a W&I tax policy, you would bridge that gap quite easily. So I think eliminating uncertainty is one way I'd look at it. The second way I'd look at it is that, what are the buyer's toolkits, right? The buyer's toolkit is, adjustments. The buyer's toolkits are earnouts. But the W&I tool is also a very integral part of the buyer's negotiation toolkit, and they are not distinct. It's not that because you have an adjustment or because you have an earnout, you can't have a W&I wrap to that in order to deliver the entire deal value that you have in mind. So I would really say that this is one element that needs to be looked at. The other feature is that imagine if you're a promoter and you're trying to sell a business in order to plan for succession. Now, if you say have 2 children and you want to give cash to one, operating business to one, but the operating business has given the warranties, what you're doing is then storing up problems. So even for our friends on the call, on the webinar, who are representing Indian business, it's a very pertinent way of ensuring that, look, liability is ring fenced, succession planning can happen properly. So there are various scenarios where I think this tool has real significance.
Absolutely. I mean, you rightly said. I mean, uncertainties can be answered by transferring the risk to the insurance company. And like I said, where fraud can be one situation for the buyer, I think it's the biggest utilization is for the seller, who can make a clean exit. It could be various situations, could be distress, and therefore you're selling and therefore might not be able to give adequate indemnity, and the buyer is not willing to do the transaction because he's not comfortable with the indemnity you've provided, or it could be a private equity fund. But the main thing is this product actually helps in getting clean exits and is therefore extremely beneficial for the sellers as well, including when you're making, say, a cross-border acquisition. You're making an acquisition in a different industry. You might not be completely savvy with the local laws, with, what apply, and that's what happens. It's a risk mitigation tool where you're transferring the risk to an insurance company who's an S&P solvent A+ company who is willing to take the risk of making sure M&A transaction is successful.
Thank you, Mandar. Thank you, Bharat. Mandar, you mentioned clean exit for sellers. I'm sure that's a very paramount consideration for PE funds in particular. And I understand that PE was the driving force or the primary driving force behind the W&I market, but it appears that the market may be changing in certain respects. Could you shed some light on how the market has evolved, how it's different today from what it was earlier?
Absolutely, Rohit. You're actually spot on. The product in India was primarily being used until a couple of years back by private equity funds, and I mean that's no surprise given that PE funds are in the business of making successful exits, without any contingent liability, without any recourse. And so these PE funds have been using these products in other geographies, right? US, Australia, Europe, and it was only obvious that they started using it on Indian transactions as well. But what's happened over time is that the utilization is now not just with PE funds, but we get a number of inquiries, probably more now, from corporates. And I think this is a lot to do with what Bharat initially said, with the fact that M&A consolidation is happening. Maybe COVID is going to drive this further up, furthermore, because of bankruptcy code. I guess more crown jewels are being sold by corporates. So we're actually getting a number of inquiries from corporates. It started off a lot with IT firms earlier. We all know IT firms tend to be more acquisitive globally, making acquisitions in US, Australia, Europe, across the board. And they started using it there. Was my initial experience with corporates, but now a number of domestic corporate deals are also using it. The other change I've seen is that, Bharat did mention about tax policies, and I think we've been doing tax policies for the last 10 years. But the number of policies that we used to do tax versus now is far lower, and I think it's a lot to do with a bit on clarity on the ruling, given that there is grandfathering of investments pre-17, and there's clarity about taxation post that. But it's also to do with the fact that W&I policies are getting more used because people are getting more comfortable with it. lawyers are getting more comfortable with it. They're recommending more. And therefore, I think now my ratio is 70% of my policies are W&I versus only 30% are tax. Right. And I guess there's a bit of change on both sides. There is, of course, increase in demand, which means more corporates, more clients are looking for the product. That's also led to more supply from the insurers as well. 3 years back, I used to have 1 or 2 insurers providing me terms. Now I have 5 or 6 insurers, which obviously means better, broader coverage, also means reduction in pricing because of competition, right? And I guess with more law firms getting more comfortable, the number of, I love to say lawyers are a mouthpiece when it comes to these products because they know when it is best applicable on a particular transaction. I'd be lying if I say it's useful on every transaction, but they know exactly which deal it is. So I think with all of that, the market has evolved significantly in India.
Great. So thank you both, Mandira. I think we can move to the next slide. Or Tejas, can you move to slide 5, please, on key levers? Thank you. Bharat, first question for you. So just at a high level, drawing comparisons with a traditional SPA, where the buyer is obviously looking at the maximum possible liability cap for the seller, protect its purchase price, have really low thresholds for de minimis and baskets, make sure that your survival period for warranties are as long as possible, fundamental warranties survive in perpetuity, etc. And the focus is to minimize as many limitations of liability as possible, at least from the buyer's perspective. Now, are these concepts and objectives, are these relevant? Do they translate well into a W&I context?
Yes, Rohit, thanks. I think that's a relevant question. Just to, conceptually get one's hands around what does this really mean? And it may sound unfamiliar. It's a sort of a highly customized insurance policy in some ways, but really, if you're familiar, with the SPA, then effectively, it's the other side of the coin, if I could put it that way. So just to recap, what do we, as you said, what do we worry about when we're talking about an SPA? You first want your liability cap, and you'll again split that liability cap between your fundamental items, your business items. And it's very similar, in a W&I policy where you have your cover for business related warranties, and similarly, your cover for your fundamental warranties, and the covers could be quite different. And I think Mandira will explain the breakup of how the economics of that works and what are the driving elements. But that's the first concept to bear in mind, the aggregate cover. Then in an SPA, typically, there will be a de minimis, which is essentially just simply a threshold for eligibility of making a claim. And again, that typically gets, so that concept again is common in a W&I policy. You will find that concept in a W&I policy as well in terms of eligibility. In an SPA, you will have, the concept of a basket. And essentially a basket, just to recap for everybody, is that look, claims must sort of reach the basket and go beyond the basket, and then a claim can be made by the buyer against the seller. And the idea is that frivolous claims or very small claims people don't bother about, because if you're going to courts or going to arbitration, you've got to exceed the basket. In an SPA, you could have a tipping basket, which is that once you exceed the basket, you recover from $1. In a W&I policy, you will have the same concept, and it's on the slide. You've called it the policy retention. And generally, I think what happens is that the retention doesn't dip, but as I'm sure Mandira will tell you, there's a lot of flexibility if you want to negotiate around these things. But just to keep it simple, I think the way to think about it is that if there is a risk, and if there is a claim, and there is a payment to be made, then effectively the equivalent of the basket, right, becomes an amount which is deducted or retained, and that's why it's called the retention or the deductible, by the insurer. So I think those are some of the key, if you like, elements that one needs to keep in the back of the mind, that it's familiar stuff. But there is one area which we should talk about and just reflect about a little bit, right? Because the whole idea is not that you play into the moral hazard and one is lazy about how one enters into the W&I, because it's a very simplistic view of saying that, look, it's neither the buyer's risk nor the seller's risk, it's the insurer's risk, and so let him deal with it. And obviously the insurers also have counsel. They've invented these policies, they know how they work, and they have this concept which you again put on the slide in terms of exclusions. And there are some exclusions which are standard. So there are matters relating to anti-bribery, could be standard exclusions. But there are also some broader exclusions. So forward-looking statements, price adjustments. There could be instances where if it's a very high-risk business, that business or certain elements of that business, if it's oil and gas, or if it's say gems and jewelry, could be excluded as an area where you can take insurance. There could be items relating to accounts receivable or certain types of pollution that is not recoverable. Things like peculiar concepts around stamp duty or certain types of taxes. So the whole idea is that, and I think we'll talk about it later when we talk about process, but one needs to have a very focused approach in terms of really identifying what is material risk, approaching the policy from that standpoint, and bearing in mind that, look, it's not a carte blanche that once you sign on the dotted line, it's really not the buyer's problem or the seller's problem, it's a third person's problem. There are some exclusions out there, and one needs to evaluate those exclusions to really see and ask yourself, look, will a simple policy do? Or there are certain exclusions which I'm really bothered about, and therefore I need to get an additional rider or an additional policy, or at least talk to people like Marsh, who are the brokers, and really understand how this risk will be mitigated.
Thank you, Bharat. That was extremely helpful. Mandara, just to take a very basic hypothetical example, we have a target of enterprise value of 100 rupees, the equity value is 70, so it's a 100% acquisition. So effectively 70 rupees is what you're paying for to acquire the target. Now, in this situation, how does the buyer think about what is the level of coverage do I need? Do I take coverage for the 100? Do I take coverage for the 70? Or is my loss going to be somewhere below that, and that's the right level of coverage that I should be paying for?
Thanks, Rohit. I think it's a very good question, and this is something which we are asked very often from clients when they're deciding whether to take W&I insurance or not, and if so, what's the limit, right? These are limit of liability policies. The loss that the policy will pay up is whatever the limit that they buy, from the insurer. And I think it's from experience, I can tell you that we've typically seen 10 to 30% as the broad range where we see clients take the limit. And this 10 to 30% includes all three buckets in an SPA, which is your fundamental warranties, which is your share title capacity authority. It's your tax warranties, which is to do with the company tax, sales, service tax, corporate tax. And then the third bucket being the general warranties, which is anything to do with the business, right? So generally speaking, we see 10 to 30% of the deal value what clients take. In fact, we just came out with our data in 2019. The average for Asia was about 24%, right? So it's within the ballpark of 10 to 30%. But I think it all depends on what is the sector and what is the key motivation for buying the insurance, right? If it's a real estate sector, for example, land title becomes an important part of coverage, and as we all will agree, in a real estate deal, title to land is where the majority of the value is locked, right? So perhaps in those situations, you might take a higher limit, maybe up to full deal value, 100% for fundamental warranties, and maybe take a sub limit of a smaller number for business and tax for 10-20%, because you don't expect losses on business and tax to an account, on account being 100%, right? There's good level of diligence, which is typically expected, disclosure being made. So you don't expect the entire deal value to go, to be cleaned up. But yeah, on title, for example, that can result in a full loss, right? But if it's another asset which is being sold, which is not a non-real estate deal, maybe you don't want to take full fundamental warranties, because if you've done diligence on title, I think that's an easier risk to mitigate, right? And then there's a pricing implication as well to it. Fundamental warranties are cheaper in terms of percentage wise, so the pricing becomes a lot cheaper, but the business and tax obviously are a little expensive, because you can see multiple losses and the chances of losses are higher when it comes to these these areas. So it's a bit of depends on what the mechanics are. Typically, like I said, we don't see full 100% being taken. 10 to 30% is typically where we say. I think the other factor which also plays up is who's paying for these for the policy, right? Sometimes
right,
both are paying for it. You might be able to take a higher number because both of them have a kitty of, premium that they can accord for, versus a situation where only seller paying, or a situation where only buyer is paying, right? It's all ends up being a lot of commercial between the parties in terms of, how these, and at the end of the day, Rohit, Bharat, you would agree in your transaction, you also agree on indemnity caps and an SPA, right? So it is a commercial call at the end of the day. All you're trying to do here is you're trying to replace that indemnity with an insurance policy.
Right. Bharat, so we just, actually both Bharat and Mandra, just could you tell us something about how to approach the exclusions that come in the policy? Now, we know that there are certain standard exclusions which we can't do anything about. No insurer is going to cover anti-bribery. Environmental pollution, for example, is a standard exclusion. So that's something that's out of coverage to begin with. But depending on the risk profile of the target, and probably after the insurer has looked at the quality of diligence that's being done, certain deal-specific or target-specific exclusions can also come up. So what's a good way to prepare yourself for such exclusions? And if they do come up in the policy, then what's the right way to negotiate around that?
See, if I could jump in, I think the guiding principle for insurers is what is that can be diligence versus that is hard to diligence, right? I think that's one guiding principle insurers take on what is standard exclusions. Things that they think are hard to diligence as an area, they will not cover, and they fall under standard exclusion. Transfer pricing is one example. It's extremely difficult that, if there's a group company, if things are happening at arm's length basis or not, what is the, related party transactions. And while there is diligence that can be done by Big Fours, it's an area which is always has a lot of subjectivity. So this is one standard exclusion which is across the globe. It's not an India-specific exclusion. No insurer, no W&I policy wants to cover transfer pricing for that reason, right? That's one example I can give. Actual knowledge, like I said earlier on, the policy doesn't cover for what is known, right? So I think anything to do with specific indemnities, known things which are known, I think that's something which insurers will not be able to cover. Again, the idea of this policy is to cover unknown. Right. We've been discussing it's a backward-looking policy, and therefore any forward-looking statements can't be covered. Covenants, undertakings are not covered. Insurers have no control over it. Right. Again, impossible to diligence on what's going to happen in the future. So that's something they can't cover. Otherwise, there are standard exclusions, things like Bharat already mentioned, any anti-bribery, corruption, money laundering, sanctions, those type of reps which are immoral, so to speak. Insurers find that hard to cover in India. Criminal fines and penalties, these are uninsurable at law. This is not a W&I problem, this is a public policy problem, right? Law doesn't allow you to insure criminal fines and penalties. So those are some of the standard exclusions, but with respect to deal specific, it obviously depends on what the asset is, which industry. Example is listed deal, structural defect can't be picked up. Another example is I was doing a transaction which had Thailand subsidiary which had less than 5% revenue. Now the client decided not to do diligence on that because it wasn't material to them. They can't expect insurers then to cover it, right? In fact, insurers did cover the fundamental for the Thai subsidiary, but they couldn't cover the business and tax because there was no diligence done. Now that's a deal specific exclusion. It's not because they couldn't cover the Thai subsidiary. It's just that because there was lack of diligence done. I think as long as there is good diligence done by the buyer and thorough disclosure made by the seller, we can get a pretty robust coverage from a W&I policy. At least that's what my experience has been. Bharat, I don't know if you have anything to add here.
Yeah, no, I completely agree, Mandira. I think Rohit, the way I would approach it is firstly, as Mandira alluded, what you do what you can do, right? And what you can do is do a good job in your diligence and make sure that there's a very high degree of satisfaction by the insurers that adequate diligence has been done, because if not, and if they feel that it's inadequate as compared to market, they see hundreds of these diligence reports all the time, they will add to your cover. Equally with the warranties as well, right? If they feel that, look, there hasn't been an appropriate arm's length negotiation of the warranties, if the warranties are very broad or sloppily sort of drafted, or and there is an overhang from the warranties, then again there will be exclusions baked into the exclusion section, or the warranties themselves in terms of the warranties cover sheet that one looks at will essentially qualifications will be added. But from the lawyer's perspective and for the lawyers on the call, I would say read all the exclusions very carefully. If they are make sure that on title related matters, if there are exclusions impacting title, that you discuss that upfront with, again, the brokers, with the insurers. Protect yourself against that. If there are other exclusions in terms of tax exclusions or in terms of business exclusions, then discuss them with the relevant experts in your deal team, so that you can again assess the impact of what some of these exclusions are, and understand the rationale behind where these are coming. And so again, if there's a particular risk which keeps recurring, which is a part of an exclusion, then that might require a separate discussion. And therefore, what I would really say is, and it's really the the M&A sort of mantra, that in some ways price in some ways is a price range is negotiated upfront, but maybe not the definitive dollar value, because as one goes through the M&A process, as you do your diligence, as you talk to your insurers, things and issues come up. And so very often what will happen is that on the back side you'll give a range saying this is my range, or this is my number subject to diligence, etc. So that if there is a small cost to be factored in for the insurance premium, etc., or a second policy, then you can factor that in. So that's what the bankers do, and the corporate finance guys at the clients end do. But based on our deal experience, we've seen a small window being left open in these situations.
Great. Thank you, Bharat. Thank you, Mandira. We'll move to a couple of case studies now. Tejas, if you could please move to slide 7. Thank you. Bharat, do you want to take us through the first case study in relation to this real estate acquisition?
Yeah, sure. I mean, I think what I would really say is that this involved. I won't get so much into facts. It's basically sale of an office building by a global PE fund to an Indian real estate buyer. But the question, of course, is that look, if Mandira will tell you that a few years ago it was very difficult to underwrite policies for real estate risk. And India is, one of those economies where countries where you don't have a digitized title system. So naturally, the diligence becomes a little bit more difficult. But I would really call this a case study in terms of, clarity and clarity of approach. So it's clear that, you're selling a real estate portfolio. It's clear that therefore title will be an issue. It's clear, therefore, that it's important to get the title diligence reports done to a high standard. And vetted by the insurers and their counsel, so that when they've looked at that qualitatively, they're clear that yes, we're good to go. And once you get that green signal, of course, you're not buying an asset, you're buying an entity. Since you're buying an entity, there will be a number of other provisions, right? You will have in a real estate company your usual AMC issues, and your management, tax issues, etc., which will also need to be diligenced. But once you get the principal risk out of the way, and having done the principal diligence and got basically a green signal, then you can invest time, money, and effort in wrapping up the other diligence exercises and moving forward. So really the message being one of clarity of purpose, smooth execution, and the fact that the market has now broadened, as Mandira was alluding to earlier, to a situation where rather than being tax focused, it's really now business focused, and you can cover issues like real estate title, which hitherto people who been doing deals in India will tell you was inconceivable even say 5-6 years ago.
In fact, just to add there, the pricing actually for real estate deal is actually lower compared to your other non-real estate deal, which is how insurers look at the sector. So I mean, our typical pricing is 2.5% as a one-time premium of the policy limit that you buy, what we were just discussing previously. But for a real estate deal, the same pricing is 1.5%. In fact, for a larger deal, it can even be sub 1%. So definitely an area where we're seeing a lot of activity, a lot of even the retention amounts are a lot lower when it comes to real estate. So definitely one area for utilization.
The degree of comfort the insurer has with respect to a particular risk is obviously having an effect on pricing. Like they're more comfortable with the risk on fundamental qualities, so the pricing is lower. Non-real estate risk is considered higher. Tejas, can we move to the next case study, please, on slide 8? So, Mandir, we have a list public M&A transaction here, or not something that's typically covered by W&I. Could you walk us through this example, please?
Absolutely. I think typically, obviously, a listed deal, you won't have a W&I policy because the stake being acquired would be minority. There wouldn't be thorough diligence done because of, and definitely no disclosure schedules by the sellers, right? But this was a deal where there was a significant minority taken. In fact, it was going to be a controlled deal with the open offer. And I think because of the fact there was a listed deal, timelines were critical to the buyer. And for a listed deal, the stock price movement can significantly impact the transaction. And so therefore we had to do this very quickly. In fact, we did this transaction in a very short time. And the other consideration was that because they didn't have enough time, they couldn't do thorough diligence on all the assets because it had multi-jurisdiction operations. Material geography is about 85-90%, so they did diligence on that, but the remaining 10-15% geographies were not diligent. So what we did was we actually incepted the policy because of the time pressures for the material geographies, and then we endorsed the policy, which means they completed the diligence on the non-material geographies, and then we have the same coverage for those geographies as well. But the other key thing to keep in mind is that we actually got the open offer shares acquired through open offer also covered in the insurance. So whatever stake was increased of the buyer from the equity that they bought through open offer, that loss was also getting picked up by W&I policy, which was greatly helpful for the client. So I mean, this just shows how the utilization has evolved, right? Obviously secondary larger buyouts that use it, but you start seeing listed deals, you start seeing in real estate. The whole idea is that, and that's the thing. We don't know what next is going to happen. We know, Bharat and I were chatting about distressed assets. And I know in US and Europe, you have synthetic warranties that are given in an SPA for these distressed assets because there's no seller, and those get picked up by W&I policy. And I see no reason why these things are now going to happen in India over the next 6 to 12 months as well.
Thank you, Mandir. I think this also underscores the point you made earlier about how it's a very bespoke and a tailor-made policy. It's not like a standard set of terms and conditions are being imposed on each and every deal. The insurers do have some flexibility there. Tejas, can we move to slide 10, please? Thank you. So Mandir, first question for you. In fact, we have a similar question already from the audience on this. It is regarding the stage of the deal process. So obviously in an auction situation, if the policy is stapled as part of the deal, then it's there since the beginning of the deal. But otherwise, normally in a negotiated transaction, what's the right way to start thinking about the time at which you should introduce W&I insurance?
So thanks, Rohit. I think the process takes about, say, three weeks. Typically 3 to 4 weeks is what our experience is from day zero, which is when we have no information, to having the policy done, dusted, incepted, which means on risk, right? That's about 3 weeks period is how we think about it. But I think it's all depends on what the commercial rationale again is. If it's an auction process, we work with the sellers a lot sooner, where the sellers work with us, we negotiate the policy, negotiate the terms earlier on before the buyer even gets an exclusivity, before they select which buyer they want to go ahead with, and then we do the underwriting with them in that phase. Also, a situation where there's a bilateral discussion where the SPA is being negotiated between two parties, an exclusive discussion where it depends on how much time you have. One should think about that the ideal SPA is the second draft of the SPA when both the parties have looked at it, because that gives a more balanced position to the insurance company. But this is the way the policy is bespoke, even the process is bespoke. Broadly speaking, it's divided into two phases. The first phase is the marketing phase, as we call it, which is basically approaching the insurers, asking for terms, right? This is when they'll get to know what the pricing is, retention is. They're actually going to give you comments on the SPA from coverage as well. So this is a very useful document for the parties considering W&I, and there is no cost involved. It's a free option. Clients can decide, can go down this path and then decide, no, this doesn't them, and that's the end of it. It's the second phase, which is the underwriting phase, is where the cost gets involved, because like Bharat was mentioning, they will actually hire an independent counsel to help them in their diligence. So once we select the insurer, they will appoint a counsel, and together with the counsel, they will do diligence and policy negotiation. So the marketing takes about, say, 5 days. We can get terms in 5 days, but the underwriting takes about anywhere between 2 to 3 weeks typically. And it's actually in clients' interest to give a little bit more time to the insurance company. They are happy to move as quickly as you want, and I'm sure Bharat can vouch for that. That there is no reason that we've never had a situation. I've done lots of deals where insurance has delayed the transaction. But giving a little bit more time to the insurance company helps better coverage, because they get time to digest the diligence reports, they get time to digest what has been done to get a better coverage position, versus a situation where you're rushing the process, in which case they might not, have the luxury to look at every situation, and that's where the coverage position changes.
Thank you, Mandra. I think your insights on timelines are particularly useful, because I think it's one of the areas or so-called misconceptions that a lot of clients who are not familiar with the product have, that it's a complicated insurance product. And once we introduce it into our deal, it will complicate things, it will extend timelines. But that may not necessarily be the case. Bharat, what do you have to say on that? I mean, do you think it dovetails well with the overall M&A deal process once you introduce W&I into it?
Yeah, no, I think Mandra has already answered that in many ways. That frankly, the people who are involved in this process, certainly know what they want. I think the problems come up, and the learnings that I may want to share are that, where, say for example, if you have a very clear seller who's saying, a private equity seller saying that, look, I want a nil recourse deal. So there's clarity from day one. Like the case studies that we looked at. Just a moment ago, there was clarity from day one. But the problem really comes up when there is ambiguity either on the sales side or the buy side. And say, the seller doesn't have a banker. He's been tom-tomming the deal in the market for some time. He's giving some signals here, some signals there. People are not clear how much liability he's willing to take. So that creates problems. On the buy side, someone is not clear that, look, am I willing to take a liability cap on the business side of 10% of what I'm paying, or 20% or 30%? And if the seller will give me, say, in the range of either the seller will give nil, or the seller, is sort of somewhere in between, but he'll give up to 10%. He's really leveraged, he's really stretched, he needs the cash. He's not going to be able to, really secure you, and you need to go 20-30% and, try and satisfy yourself. It's where people cannot make those decisions, and there is uncertainty, that things go in circles and circles and become inefficient. So I think as long as there's clarity of purpose, the transaction intermediaries see these warranties and see these schedules, see the disclosures time and time again. And it's actually surprisingly fast how quickly they get to grips with what is happening in the asset, what are the legal issues, what are the regulatory issues, and how quickly the response comes. So I think there is a pleasant surprise, actually.
Thank you, Bharat. I think that's a great note to end the third segment with. Tejas, can we move to the next slide, please, on concluding thoughts? Thank you. Bharat, Mandra, would you comment on these three topics that we mentioned here? The cost of cover, cultural issues, and is this part of the core M&A toolkit from this point onwards?
Maybe I'll just quickly. I think a lot of ground has been covered, but from my standpoint, I'll just quickly make a few observations. I think the first really is that, look, again, clarity is needed from the beginning, because if you're clear how the risk allocation should work, then all your work streams align accordingly. So you'll get your diligence done in that manner. You'll mark up your warranties in that manner. You'll appoint the deal intermediaries in that manner. So I think it's very important for deal participants to have clarity. What happens is also one has to be sensitive that since ultimately this insurance is underwritten in a foreign market, there is a certain drafting style, there is a certain style in terms of how the diligence reports should look, how the information should be presented, and you really, there are few counsels currently in India who can administer that level or that threshold of reassurance to the insurer that, look, you're dealing with someone who is sufficiently sophisticated to review the information, highlight the issues that need to be highlighted. So I think a lot of it is, in some ways, I hate to use this expression of a club, but in some ways, it's really people who have the sophistication and the ability to deliver, who can work on these. And it's important for market participants to know that if they really want to get the best deal and the best risk allocation package.
Yeah, I mean, from my perspective, I think my biggest data point that I can give is that the clients who've used the W&I policy on one deal, we have seen them always considering them on their next deal. In fact, the same client would use it on a number of deals and will consider them in all their deals. So I think that's one, the fact, the taste of the pudding is in the fact that clients who've used it, obviously there must have been something right that the policy must have done, both from unlocking the deal value, from the process that must have been there versus, a successful M&A transaction. I think that's one data point I can give you, which probably reflects on how the future of W&I is going to be. It's no longer a situation where it's far and few discussions. We have a number of discussions and law on a number of deals. A lot of times it's not even applicable to have a W&I policy in there. But the fact that people are talking about it means that it's reached a stage where people know about it. It's no longer an alien concept. It's no longer a concept that's been introduced. Sure, people need to know a lot more about it, but people know that there is a product like this that is available and can perhaps help them in their M&A transaction. So I think that's one comment I'd like to make.
Thank you, Mandirat, and thank you, Bharat. We have a bunch of questions which have come now, so we have about 10 minutes to go. So I'll just go through the questions. So our first question, I think the most topical one here, is there an expectation that premiums would rise because of COVID from the 2 to the 2.5% range that we discussed? Is it expected that COVID will have an impact on premium?
My view is no, I don't think so. There should not be an impact. In fact, while COVID is a relatively new area, as we're all still unearthing what is going to happen because of it, the initial position that insurance was a lot more harder against COVID, and what was they started getting very worried about losses coming out of COVID, be it business disruption, business downturn, bodily injury, or it could be to do with the fact that government has made some regulatory changes, so that could impact the business. And this is where they started, when COVID just started, when pandemic started. But now they've reached a situation where they're considering merits of each transaction. What is the implication of COVID going to be on it, and then negotiating the position around it. So it's a very deal specific thing, and we haven't seen any. The impact would be on coverage, depending on what industry and how they will get impacted by COVID, but it is not on pricing. My view is pricing has been softening in India for a few years, and given, like I said, the number of insurers who are looking to do Indian transaction, I only see it coming down. So no, short answer is I don't expect pricing to go down.
Thank you, Mandira. The next question we have is, so if in a situation the seller has already taken a professional indemnity policy and a DNO, and that's getting passed on to the buyer as part of the deal, then does it still make sense for the buyer to go for W&I when it's getting specific coverage under these other insurance policies?
Actually, what I initially said, these policies are forward-looking in nature, which means that you will have a professional indemnity insurance, also called errors and omission insurance, today, that if tomorrow there is some error that happens from the client, if there's a losses suffered because of that, if there's a banker advising on a transaction and there is an errors and omission claim that happens on them, that's actually a forward-looking event. This is an insurance which is a backward-looking insurance where, like I said, the loss has already happened, the error has already happened, it's just that the discovery hasn't happened. So your traditional insurances actually don't pick up what the W&I policy picks up in any case. And the second point is, if there are reps in the SPA about some of these things, for example, if it's a hospital chain and if there's a rep around medical malpractice, the insurance W&I policy will not pick it up, because if it's a hospital chain, you're expected to have a medical malpractice insurance, for example, or a professional indemnity insurance, for example, right? But the short answer is these policies are forward-looking in nature, while W&I policy is a backward-looking in nature.
So on the inclusion, also sorry, on the exclusions, is it fair to say that the industry as a whole does not want to be underwriting the same risk under two different policies? So if I have professional indemnity insurance for my clients and my business, then reps on that aspect in an SPA will be excluded as a standard exclusion.
That's right. But in any case, the question was about loss that will happen in the future. That in any case, the W&I policy can't pick up, because it's a future event. W&I policy can't be a catch-all type insurance where it picks up all sorts of losses. The idea is that it's picking up the M&A losses, right? Fraud, books of accounts being cooked. More of there's a regulatory or a compliance related loss that the company suffers. All those are the sort of things that this policy, tax demands, tax notices, all those are the sort of things that this policy.
Thank you, Mandra. And you mentioned tax here now. Bharat's question for you. Now, normally we will see coverage for taxes either as part of the loss definition, or they'll try and have a gross up clause, which makes them whole for any taxes they may have to pay on the claims that they're making. Now, is that something that's also a relevant concept in a W&I policy?
Yeah, so sorry, Rohit, the line got a little bad, but if I understand correctly, your question is that in case there's a payment made under the W&I policy, is it grossed up for tax, correct?
Right, that's right. That's right.
Yeah, so I think up to up to the cover amount is my understanding. So therefore, if your cover was at 100 rupees, the gross up will not take you to 115. But as long as it's within the 100, then it can be calculated within the definition of loss. But then 100 would be the outer cover, of the payout.
Yeah, that's
right. Mandar, we have a question on the minimum deal size. I think the participant wants to know if there is a minimum size of a deal after which insurance makes sense.
Yeah, I mean, the fact is it needs to be commercially viable for the client, right? And so therefore, and these insurers work with the minimum premium per transaction that they want to make. So there is a bit of a sweet spot when it comes to transaction size. Typically, if our recommendation is that if the policy limit is less than $8-10 million, it starts to get expensive. I have done policies which are even $5 million. So it doesn't mean it's not available, but commercially it starts to get expensive. The range that we've given 2.5%, that range, the pricing comes out of the range if your limits are lower than say $8-10 million. If I extrapolate that from a deal size perspective, given that you take typically 10-15% of a 10-15-20% of the deal value, then I would imagine $50 to $100 million is the sort of deal size that is a minimum that you probably will consider a W&I policy. For a $50 million deal, if you take a 20%, that's $10 million, and that sort of is fine, right? But if $50 million and a 10%, which is a $5 million limit, then the pricing will probably be slightly north of 2.5%. So we typically recommend $50 to $100 million as a minimum size. Transaction size can go all the way to multi-billion dollars for some of our transactions which we've done in India.
Thank you, Mandra. And just one final question for both of you: is a buy side policy considered superior to a sell side policy? I mean, in a buy side policy, it's the buyer which is the policy holder. Sell side policy, it's the seller. So, what are your thoughts on which policy is better, which is more common also in the market?
Globally, in India, 95% plus policies tend to be buy side policy. And I think it's more to do with the reason of placing these policies. We've been discussing that the reason to take these policies is to help client make an exit, right? Make a clean exit from the transaction. And therefore, if the seller is the insured, means that he needs to be on, firstly, he will have to give indemnity in the SPA, because the buyer has no insurance policy. They will claim it as per the SPA. From the seller. Seller will then claim from the insurance company. Insurance company will pay the seller, and seller will pay the buyer. It's like a reimbursement. But that's not really an exit, because he's still on the hook. He needs to give indemnity. So that's one reason. The whole idea for this insurance is that the sellers necessarily don't need to give indemnity in the SPA. They can have a clean exit because the buyer can directly claim. The other difference is how your SPA links. Your sell side policy has to match to what is agreed in the SPA. So whatever periods on the limits, right? If you've agreed to a 10% indemnity cap for a 12-month period, then that's the maximum, because that's the seller's risk. A buy-side policy helps bridge this gap where the buyer can go ahead and take a 30% limit for say 7 years. And the biggest difference being a policy can't cover seller fraud. Seller can't cover themselves and expect insurance to pay. It's moral hazard. So globally in India, and like I said, while buy-side policy means buyer is insured, a lot of times these discussions are initiated by the sellers because it helps them get the deal done. So buy-side policy actually is beneficial for both buyer and the seller.
Thank you, Mandra.
I completely agree with all that. Yeah.
So we still have some questions, but unfortunately we've run out of time. So we will definitely get back to those questions with responses over email after the webinar. I'd like to take a moment to thank both Manjara and Bharatu for taking the time today and for helping us demystify a lot of concepts and misconceptions that people had around W&I insurance. We would be extremely grateful for the audience's feedback on today's webinar. As a firm, we're committed to making sure that the content remains clear and relevant. So we'll put up a poll on your screen. This should be coming up right now. Tejas, can we put up the poll screen? Thank you. So the screen will be up for 30 seconds. Please click the option that you agree with. Once this is closed, once the webinar is closed, there'll also be a short survey that will open up in your browser. We would be very grateful if you could fill that in as well. So thank you everyone for taking all the time again, and thank you for sharing your feedback. We hope the webinar was useful, and we look forward to more such sessions. Thank you once again. Good day, and please take care.
Thank you very much for having me on this. Thank you very much. Much appreciated.
Thank you.
Thanks, Bharat. Thanks, Rohit.
Thank you all for listening.
Bye-bye.